Phil Palumbo. He's the founder, CEO, and CIO of Palumbo Wealth Management. Phil, thanks for joining us. Are you concerned that this market might be overbought right here?
Absolutely. I think that's my number one reason why I'm cautious in the short term, but more optimistic in the long term. So, looking at sentiment and some overbought indicators, the RSI is one of them. There's no doubt in my mind in the short term, the market is way oversold,
So,
way overbought.
what are you telling investors as far as positioning at this point?
So I'm cautious in the short term, and I have a lot of cash in the short term, simply for the reason of, think about the Fed and what the Fed has done so far. It's not over yet, so we're still going to raise rates. And if you look at since 1989, there's a direct correlation with earnings growth and the S&P 500 returns, right? And that happens about 74% of the time. The other 26% of the time, when the Fed intervenes, as the Fed is doing right now, the correlation is actually negative. So this year, the forecast for earnings is pretty much flat to up 1-2% consensus. And you have a Fed that's still tightening. And that type of an environment, especially as overbought as we are now, it's very difficult to take on a position in risk assets such as equities right now.
When you say cash, do you mean cash or cash equivalents?
Cash equivalent. So right now, money market funds are yielding anywhere
Money
between four and a
market
half
funds, yeah.
5, and treasury bills are, between 4.5 to 5.25. So that's where we're parking cash right now.
So where are you in terms of your cash holdings today, like percentage wise, and where is that versus maybe your average?
Yeah, so average we're normally between 2 and 3%. Today we're 15 to 18%. So
Wow.
so far coming into this year, we've been wrong. But last year it worked really well for us. So we're patient. We're long-term investors. When you think about where the market's trading right now, the forward multiple around 19 times, you got a treasury bill around 5. It's really tough, especially in an overbought market we have today. It's really tough to take a position in the market. But that doesn't mean that there aren't opportunities out there. Every single day there are opportunities where certain great businesses are trading cheap for whatever reason. So we're always on the lookout for that. And just because the market's overbought doesn't mean there are not other opportunities out there.
Money market funds have been a very hot topic among guests
Yep.
that have been speaking to Paul and myself over the past few weeks and just in recent months in general. What is it about money market funds? Is it just as simple as being able to yield more than you could have over the last decade or so?
Well, to me, it's a very simplistic type of investment. I mean, it's short-term paper within their instruments. Oftentimes, there are treasuries. There could be some repos in there, some short-term corporate paper as well. But I mean, these type of investments, it really doesn't concern me. I mean, we work with Federated. They're one of the best money market fund managers in the world. They're one of the largest. We speak to them consistently to really understand the portfolios that we're invested in. There are different types of money market fund options that you can invest in. Some are more aggressive than others. We tend to stay on the more conservative side. This is cash. This is where we don't want to take risk versus going into something like equities or other type of risk assets.
So, what's the catalyst to move that money from money market funds into equities?
Yeah, so I said to you, and I started the conversation saying I'm cautious in the short term, but I'm more optimistic in the long term. The reason why I'm more optimistic in the long term is simply because we finally got back to a more normalized rate as it relates to the Fed fund rates, right? 5.25. So now, if economies do weaken, Fed has more flexibility to decrease rates, which can help create an expansionary type economy. So I love that. Number two, AI. So AI is for real. It's gonna create productivity for the economy, and that's here to stay. And that's gonna I think really help build a really nice strong economy as we think about things going forward. And then three, the consumer is strong. So my whole point in just telling you that is that any type of pullback in the overall equity market, when relative strength number gets below 40, we're interested in buying into that.
How much earnings risk do you think, Phil, is still in this marketplace? You mentioned that S&P earnings this year are kind of flattish year over year. Like some people are saying there's still more room to go down. There was more risk actually to those earnings.
Yeah, I think Mike Wilson at Morgan Stanley and others out there are going to be wrong. I really do. I think that if you look at the Fed Atlanta GDP now number, it's at 1.8, 1.9. If you got a growing GDP number, it's really tough to get for earnings to really get hit as bad as some of these people are saying. Number one, number two, when the job market is so strong. You look at the job opening numbers, that's still very strong. Consumers have jobs and they're spending money, as we can see in various ways. If you speak to business owners on the front line, and that's really the best way to gauge what's going on out there in the economy. And I do that quite seldom in various industries, and all of them are saying that things look good. In fact, things are actually improving, is what they are saying, right? So it's much different than looking at an economic indicator versus talking to people on the front lines in different industries. So I just think that many of them are going to be wrong. I was in that camp. I've changed my tune, and I think that we're moving in the right direction. Some of the economic indicators I look at are starting to bottom and move in the right direction. So I think we're starting to see an interesting economy. Anything could happen, obviously. Time in macro is very difficult, but overall, we've managed okay up to this point.
Phil, what are the top questions you're getting from your clients?
I mean, there's this whole lingering question about recession. Again, I was in that camp. I'm still concerned about potential recession, and so the biggest concern is, Phil, if we go into a recession, there's more downside to the market. What do you think about that? Right. And my answer is we can't time macro. We can't time where interest rates going. You can't figure out the economy, especially in this current environment right now. Any playbook that we're all used to has to completely be thrown out the window. COVID has created tremendous imbalances, and we still have a spillover from that. So, as I always tell clients, and my clients are very wealthy already, my job is to keep them wealthy. And I do that by creating a balanced, constructed portfolio. We have more cash than normal today, getting 5%. They're fine with that. And if markets do retrace from here and decline, we'll take advantage of that and buy into the stocks of great businesses that we own.